The last week's been a fairly turbulent one, to say the least. If you have a look at the chart on screen at the moment, this is basically the FTSE All-World Index. As you can see over the course of the last 4 days now, there's been a marked sell-off across worldwide equity indices. This morning, as we currently sit, we're down about 3% on the FTSE World Index, and the actual FTSE 100 for the more domestic stocks opened down about 170 points within a few minutes of the open. We have had a bit of a retracement since, but things are still looking fairly bleak out there, to be honest with you. The majority of this is driven by the Italian and other European sovereign debt concerns. The Italian BTP gapped out this morning to 6.5% yield, which is a Euro era high for the yield spread there. Berlusconi spoke on Wednesday, but unfortunately he really failed to stem the concerns. It was a bit of a non-event, to be quite honest with you. We also had the ECB rate decision yesterday. They left rates unchanged, as did the UK, as expected really. There's slight speculation around the market. We may get comments this afternoon from Berlusconi. Apologies, Bernanke. But apart from that, there doesn't really seem to be that much to stem the flow at the moment of the equity markets. There's a continuing contagion effect between the Eurozone bonds. The latest one that's coming under duress is the Belgian bond. This morning it gapped up to 4.5% yield, and if you just look at the chart, you can see how it's been fairly consistent for the past 6 to 7 months. And really within the space of this last week, concerns have passed on to the Belgian bond. They're close to 100% debt for GDP. Although this isn't quite as high as Italy and Greece, for example, this is still one of the highest and most indebted nations in Europe. Just on the other kind of main event of the week was the dollar yen. On that, we've seen the third intervention by the Japanese central bank. They've actually started selling the currency. This is the third time since September last year. It's caused a temporary stem of the weakening of the US dollar and the strengthening of the Japanese yen. As you can see, there's a temporary blip at the or a temporary rise today and yesterday. It bounced a good few percent, but in reality that's started to fade away already. Just moving on to the kind of main features on the stock side. This morning, the Royal Bank of Scotland reported their results. They announced further cost cuts and reported a net loss on the second quarter of 897 million, which is worse than analyst expectations. In early morning trade this morning, they traded down as much as 25%. This afternoon, we've got the non-farm payrolls. So for the first time ever, we're planning on doing a further podcast on Monday, just to keep you up to speed on the world events, the economic events, and also just give you a run through of what happened in the non-farm payrolls. So we'll do a bit more of an in-depth podcast at that point, and hopefully that will keep you in touch.